Dr. Babasaheb Ambedkar Open University.
Hello and welcome to my dear friends and students to Dr. Babasaheb Ambedkar Open University in the e-learning platform or the video lectures for the post-graduation diploma in finance course subject called Banking Management paper number 201. In that block number 1, unit number 1. In this subject, my dear friends, we have to learn the whole banking management. For that, our learning objectives are to constitute the money supply, then to determinants of money supply, and also to the demands for the money and the velocity of circulation of money. These four are the main objectives of particular this unit, that is block 1, unit number 1 of the banking management subject. Let's begin our session with an introduction point. Let us therefore try to give a formal meaning, or we can say definition. It is ultimately the coveted in this book, or we can say in this particular the banking management subject, that is, the money says money can be anything that is generally accepted, or we can say the acceptable, as a means of exchange, and that at the same time act as the measure and store of a value. So in a normal sense, or in a general sense, we can say that the money is that the medium of exchange at a particular time with the measurement, as well as it's a store value. And as per the Alfred Marshall, money constitutes all those things which are at any time and place generally accepted without any doubt or spatial inquiry as a means of purchasing commodities or services and defraying the expenses. This definition, my dear friends, gives by the Alfred Marshall. And the meaning and the purpose for which the money is used are clearly brought out by the D.H. Robertson. And he mentioned it that the money is anything which is widely accepted in the payment for the goods or in discharge of any kind of business obligation. So we can say that, my dear friends, if we want to purchase a goods or we want some services at that point of time, if we have the money, then it will take it in easy manner, or we can say it's in easily. So all this different definition explains the meaning of money through its functions. And that is what Mr. Walker tells us, the defining as money is what money does. So for that, my dear friends, we have to justify the function of money. And for that, my dear friends, the first thought in our mind that the money through its basic function helped us to overcome the problem of barter system, Before this medium of exchange called money is considerable in nature, at that point of time, my dear friend, there was a barter system. In that, you have to give some of your goods for procurement of another goods. This is called the barter system. Say, for example, if you need the wheat, so you have to provide a rice to them. But as of now, in a modern area, or we can say in a modern sense, the medium of exchange is only a money. So we can easily purchase any goods, we can avail any services with the exchange of the term of money. So the important function of money are summed up in the couplet. That is, money is a matter of four functions. That is a medium, measures, standard, and store. So, my dear friends, in an easy manner, we evaluate the functions are mainly concerned with these four aspects. First is a medium, second is the measure, third is the standard, and fourth is the store. So, first two, that is a medium and measures, are called the primary function of a money, as they are the basic or fundamental function of money, while the other two, that is a standard and store, functions are the called the secondary or derived function of money, as these are derived from the primary function. So let us examine the first, that is a primary function. There are basic or fundamental function of money which ensures the smooth working of economy, and they may be classified or discussed as the medium of exchange, a measure of value. In a first point, that is a medium of exchange, money act as the medium of exchange as it has general acceptability. On the payment of money, the purchase of goods and services can be made. That is, the goods and services are exchanged for the money. And as a medium of exchange, the money removes the need for a double consideration, or we can say the consolidation of wants and required under the barter system. And it differentiates buying and selling activities separately, so it facilitates the exchange transactions over there. So the medium of exchange, one of the most important function in a primary function. Next is, my dear friends, there is a measures of value. The money is common measure of a value, so it is possible to determine the rate of exchange between the various goods, or we can say the service purchased by the people. So the exchange value of commodity is expressed in the terms of money. When any goods or any services which is prescribed as an exchange rate of in a specified manner, that is money, it creates an impact of the medium of exchange also and the measure of value also. So these two are the primary function of the money. Next is, my dear friend, that is a secondary function. These functions are actually derived from the primary function. In a primary function, we define that is a two functions, my dear friends. That is a medium of exchange and the measure of value. So in a third way, or we can say the aspect of the third function as define the primary function with the continuation of it. The first and the third is that is a store value. First in the secondary function and third in a continuation with the primary function, that is a store of value. The money act as a store of value. Money being generally acceptable and its value being more or less stable, it is the ideal for use as a store of value. And being non-perishable and also comparatively stable in a value, the value of other assets can be stored in a form of money, and the properly, or we can say in the property, can be sold out and its value to be held in a money and it converted into the other assets as and when it necessary, and as an asset in a payment equal it in the value of receipt. So whatever you purchase, whatever you render, whatever you avail of services, any kind of services, any kind of purchasing of goods, that particular goods mainly impacted as a store of a value. Why, my dear friends? Because if you want to purchase a one property, the medium of exchange is only money. So ultimately money, we can say that it is store the value also. The second important point is that is the standard of a deferred payment. The concept of deferred payment or deferred expense or deferred revenue, you studied in accountancy also. So here I just justified in an economic way, or we can say for the purpose of the study of the banking management. A money is used as a unit of value and the medium of exchange, and it is also inevitable use as the unit in the term of which all the future and deferred payments are stated. The future transaction can be carried on the terms of money. The loan which are taken at the present but can be repaid in the money, in the form of money in a future. So the value of a future payment is regulated by only and only monetary terms, that is a money. And as you learn in the subject called the financial management, the one topic that is time value of money, that is ultimate defined what, my dear friend, that is a transfer of money as well as the whole function of that money. So in that, my dear friends, the next point is that is a transfer of value. The value of an asset can be transferred from one person to another person, or we can say to the any institution or to the any place by transferring money. And the transfer of money can be take place irrespective of places or time and the circumstances. And for that, my dear friend, the transfer of purchasing power, which are the necessary in a commerce and other transaction to become, has to be the become available because of the money. So my dear friend, we can conclude it with that money is a measure, the medium of exchange which can be the use in any term, or we can say that in a medium of exchange of for purchasing any goods, to avail any services, etc. And the third function is contingent function. Apart from the primary and secondary function, money also perform in a contingency ways, that is a contingent functions. In that, my dear friend, the first point is that is a equalization of the marginal utility or productivities. On the basis of prevailing the money price in a market, the marginal utility can be equalized. So also the factors of production can be employed and substituted till the marginal productivity of different factors are equalized. And in this way, the money ensures maximum satisfaction to consumer and maximum profit to producer. The second point is measurement and distribution of a national income. That money helps to measure the national income, and that the value of national income is expressed in the term of money only. And moreover, the distribution of a national income amongst the factors of production become easier because of the money. So ultimately, my dear friends, money plays the important role in a life, and as well as in a banking sector or in any sector. The money is a very important. The third point is, my dear friend, that the basis of that credit. With the growing commercial and other economic activity, it has become necessary to develop a credit system. And the money is very useful in this respect to provide a necessary basis for the credit system. So ultimately, the basis of credit is also important in a nature. And while defining the function of money, it is a most important, because ultimately the whole banking system defining the base of the credit involved, and accordingly it is the most important, because the monetary term, or we can say the medium of exchange, is a money. So it is in a very easiest manner to define the base of the credit. Then the liquidity point. The money is 100% liquid. That is, it can be converted into the any type of goods, services available in a market, and it's superior to the all assets in the term of liquidity. That means if you want to purchase anything, you have to provide the money to someone. So it is ultimately we define as that is a liquid form. Yes or no, my dear friends? So we can say that the money is 100% of what, my dear friends? That is a liquid in nature. Then the increase in a productivity of a capital. The capital takes the different form, and money is the one of them, known as the money capital. And at the liquid nature, the money can be put to any use and amongst it. So definitely it can be the use in any form of capital. So ultimately we can say that whatever the transaction are being in a banking system or anywhere, the money is important in a nature, and it is also termed as a liquidity also. So ultimately it is the most important in a nature. The next function is residuary function. In that, first is liquidity of capital. Money is not only increase the productivity of capital, as we learned in a previous slide, but also impart the liquidity to the capital also. So money help to keep capital in a liquid form for the various purposes, such as the transaction, the pecuniary, speculative motives, etc. Second point is, my dear friends, that is a utilization of resources. So money can be ensure full utilization of resources, and ideal resources can be mobilized by the means of money and to put to the productive use for the purpose of satisfaction of human wants, and also to bring out the general economic development of a country. So ultimately, if we have the resources but we don't know the how to utilize it, then your process is a zero, then your knowledge is zero. So if we have the sufficient capital, if we have the sufficient resources, so we have to utilize it in a productive way. So at that point of time, we grow up, as the banking sector is a grow up day by day, day by day, day by day. Why? Because we use our resources in efficient manner. So this point is sufficient for defining that the utilization of resources. The next topic is, my dear friend, that is a money supply. In the economics, the money delivery or the money standard is a total amount of money in a feasible in an economy at a practice point of time, or we can say it in a precise time. And there are the numerous approaches to describe the money. And further, moreover, the standard allocation normally constitute the currency in a rotation as well as in a demand security. That is ultimately the depository. Then the money deliver the confirmation are lodged as well as advertised normally by the government or the central bank of the country, that is the RBI, and the public as well as the private domain analysts hold the extensive monitorate the alternatives, or we can say the alternation in the money, that contribution on the account of its potential consequences on the charge category. So inflation as well as the business course. So we can say that the inflation is directly affected to the any business, and that the association between the asset as well as the charge is formally affiliated with the amount, the conception of money. So there are the authoritative analytical authentication of administer the association between the long-term charges inflation along with the money supply growth, and at least for a fast advancement, or we can say the fast advances in the measure of money, it is important in a nature. And hence we can say that the money contribute the consist of the diversity, or we can say the diversity, or we can say the diversified financial, the contravention, that is normally with the currency and the demand of deposit along with the manifold investment, the category of the deposit, etc. Whatever the terms we define that in the depository manner or the demand security, whatever the measures of money in economy is a benchmark by the accumulating together. These are the final conversation or constructing the monetary increments. So ultimately, my dear friends, the money supply is the most important for defining or for the growth of any country, for the growth of any business or any kind of we use in a business or nominal day-to-day life transaction over there. So the money supply is important in a nature. And when we defining in a modern monetary theory, in a modern way, it distinguish amongst the different ways to measure the money supply, and it reflect in a different type of monetary aggregates using a categorized system that focus on the liquidity of the financial instrument used in a money. And the most commonly used the monetary aggregates are, we can say that the types of money are conventionally designated as a M1, M2 and M3. And these measures of money are described for the future, or we can say in a future way also, and in this further in a unit also. So in a future way, it is also important as define the monetary or types of money in a M1, M2 and M3 position. Next is, my dear friend, that is a constitute of money supply. The economics are not the anemias about the constituent of the money supply. So let us therefore explain some important constituent of the concept of the money supply. It may be defining in two ways, that is a traditional measure and another is a modern measure. In a traditional measure, that is a currency, that is a coins and notes, and the demand deposits are covered. In a modern measures, the currency, demand deposit as well as the saving deposit in a post office, time deposit, government security and credits are involved. So in the first way, that is a traditional measures or the narrow money concept, in that M1 is important in a nature. That is, a money is the means of the payment or the medium of exchange. And therefore, my dear friend, according to the traditional approach, the stock of money should include such item that can be spent immediately. And on this creation, we can say that the component of money supply can be the comprisely, or we can say that the comprise only those things which are the readily acceptable as a medium of exchange. And that's why, my dear friend, the currency and demand deposits are the most important function in a traditional function, that it defines the first type of money, that is a M1. So in a monetary way, or we can say the narrow money, M1 is a narrow money. So M1 is equal to what, my dear friend? That is a C plus DD. Now the question is, sir, what is M1, what is C and what is DD? So my dear friends, M1 is a traditional measure, or we can say the narrow money, or we can say the type of money, the first type of money, that is a M1. And what is C, my dear friends? That is, C is nothing but your currency. And currency include, my dear friends, that is a coins as well as notes. And the DD is nothing but your demand deposits. So the M1, the measure is a very near to the RBI concept of M, that is a money, which includes C, that is a currency, and DD, that is other deposits also, which is the negligible, which is the RBI being the negligible, can be the ignored all the practical purposes. In a modern measure, or we can say the broad money, there are another concepts over there. And according to the, we can say the Milton, the Friedman says that the money supply concept is a wider, and it include saving and a time deposit with the commercial bank also, because the time deposit can be made available for the spending purpose with the limited cost. And another economics, the girl I show, even the liability of the NBFI, that is non-banking financial institution, and the bonds and the shares, that is a various grades of to the near money, are included with the effect of aggregate expenditure. And thus, my dear friend, the money supply is measured as a weight average of one currency and the demand deposit and the near money assets also. And according to the central bank approach, there are the three different approaches over there. According to the central bank approaches, the all fund lent by the financial institution should be included, because the total money supply is an important in a policy variable. So in a broader concept of the money supply has been evolved, include the very close substitute of money in the measures of the money supply. And that's why, my dear friends, it is also called as a broad money concept. Since where, my dear friend, when it is not equate as a liquid. So next is in that M2, M3 and M4 position. In a modern measure of money comprises the M and the other liquid asset or near money the item include in this list of liquid assets are, there are the four positions. First is that the saving deposit with limitation on the amount of withdrawals. B point is that is a term deposit in a bank with the prior notice. Third is that is a government security bond and the financial asset. And fourth one is that is a credit in the terms of the domestic non-financial sector, debit through the mortgage bond and similar instrument. And if the item listed that is above like A, B, C and D, where M2 that is a modern measure, then item include in a M that is a differ in a liquidity point. And as the liquidity declines from A to D point, as per the broad concept of money can be subdivided into the category called M2, M3 and M4. And thus, my dear friend, M2 is equal to what? M1, that is old. Sir, what do you mean by old? That is a C plus DD plus A plus B, that is a saving deposit plus term deposit. Then M3 includes what, my dear friend? M2. So my question is, sir, what is M2? M2 includes, my dear friends, M1 plus A plus B, that is what? M1 is equal to C plus TD plus saving deposit plus term deposit and plus government security bonds and the financial asset. Now describing M4. M4 is equal to M3 plus D. Now what is D? That is a credit in a term of domestic of non-financial sector, debiting through the mortgage, bond or similar instrument. So in that manner, we include the narrow also as well as the broad, and that's why this concept called as a broad supply of money. In that also the money supply does not include, sir, what? That is a cash balance held by the central government, then the time deposit held by the public with the commercial bank, then the we can say that the other like overdrafts until they are not used for the concerned individuals, then monetary gold, then cash balance held by the central bank or commercial bank as a reserve to support the demand deposit. So they are the not included in what, my dear friends? In a money supply. And for that, the another concept of money supply defines in a nature that M into V. Now question is, sir, what is M and what is V? So M is nothing but your money stock and V is nothing but your velocity of circulation. The point called and velocity of circulation we define in the next session, but here you justified it. The supply of money is a stock at the point of time, but it is the flow over the period of time. And when the money supply is viewed at the point of time, it the stock money held to the public at the point of time, and the flow of money refers to the given stock of money multiplier, or we can say the multiplied by the velocity of circulation of money. So this is what, my dear friends, that is a money supply defined in a nature. After watching this video, you have to evaluate yourself in a three components. The first is a long-term question, or we can say the long question. Second is a short question, and third is a MCQ. The first long question is how you have to write down the note of not on the money supply. Then write down the note on the function of money. In a short question, my dear friends, you have to write what is money and transfer of money and what is liquidity of capital. The next multiple choice question in that first question is, my dear friends, with you that the which is the correct in case of money. Option number 1 is a money is 100% liquid. Yes sir, it is 100% liquid. Second is money help to measure the national income. Absolutely right. Then money ensure the utilization of resources. Absolutely correct. So answer is D, all of the above. And the second question is, money is also known as what, my dear friend? Currency. Yes, answer is absolutely right. Then financial instrument. Yes, we studied in the broad supply concept. And the financial convenience, yes, it is also covered under the broad concept of money, or we can say the broad money. So answer is all of the above. After evaluating these phases, this three component. If you want to refer something, then you may refer this books also. So ultimately you learn all the concept of the banking management and the demand and supply of money with respect to this particular unit or this particular chapter. Hope you learn well in this particular video. Hope you learn. Hope you enjoy this video. Thank you very much. We will study the next point in a next session. Thank you very much, my dear friends.
स्वाध्यायः